Dear students, today we are going to discuss next three concepts of accounting: going concern concept, accounting period concept, and cost concept. Going concern concept. The concept of going concern assumes that a business firm would continue to carry out its operations indefinitely, that is, for a fairly long period of time, and would not be liquidated in the foreseeable future. Going concern concept is the fundamental principle of accounting. It implies that the business entity will continue its operations in the future and will not liquidate or be forced to discontinue operations due to any reason. The going concern concept is an important part of generally accepted accounting principles. Without this going concern concept, business organizations would not be able to perform accrued or prepaid expenses. Accrued or outstanding expenses are expenses due but not paid by the organization. And prepaid expenses are the expenses paid in advance. For example, rent paid in advance, insurance paid in advance, etc. Business assumes that they will continue operating for an indefinite period of time, and their assets will therefore be used in the business until they have fully depreciated. Depreciation means a reduction in value of assets due to wear and tear or continuous use. Going concern concept states that business firm would continue to carry out its operations indefinitely, that is, for a fairly long period of time, and would not be liquidated in the foreseeable future. That is, the business will continue for an indefinite period and there is no intention to close the business or downsize its operations significantly. Next is accounting period concept. Accounting period refers to the span of time at the end of which financial statements of an enterprise are prepared to know whether it has earned profits or incurred losses during that accounting period, and what exactly is the position of its assets and liabilities at the end of that period. Such information is required by different users at different intervals for various purposes, as no firm can wait for a long to know the financial results. Accounting period is an established range of time during which accounting functions are performed, aggregated, and analyzed, including a calendar year or financial year. The accounting period is useful in investing because potential investors analyze a company's performance through its financial statements that are based on a fixed accounting period. Accounting period refers to the fixed time period during which all accounting transactions are recorded for and financial statements are compiled to be presented to the investors so that they can track and compare the overall performance of the company for each time period. For example, a company records their transactions from 1st January to 31st December every year and close their accounts after that. Here, the accounting period is 1 year, that is, from 1st January to 31st December. This concept helps in estimating the profits or loss and financial position of a business for a particular period. If there are different accounting periods, then various problems can arise, like in the calculation of profits, comparability of various incomes and expenses. Thus, to study the results of a business, the life of a business is divided into short periods of equal length. Each such period is known as accounting period. Generally, an accounting period is 1 year, that is from 1st January to 31st December, or from 1st April to 31st March. Next is cost concept. This concept requires that all assets are recorded in the books of accounts at their purchase price, which includes cost of acquisition, transportation, installation, and making the assets ready to use. This concept is also known as historical cost concept. According to this concept, the assets must be shown at its cost price, which is the cost of acquisition. As a good accounting practice, they should be continued to be shown at cost. The cost concept of accounting states that all acquisition of items such as assets should be recorded and retained in the books at cost. According to cost concept, an asset is recorded in the books of accounts at the price paid to acquire it, and the cost is the basis for all subsequent accounting of the asset. The market value of an asset may change with the passage of time, but for accounting purposes, it continues to be shown in the books of accounts at its book value. For example, an asset is purchased for rupees 5 lakhs, and if at the time of preparing final accounts, even if its market value is rupees 4 lakhs or 7 lakh, the asset shall be recorded at its purchase price of rupees 5 lakh. Thank you.